Hello, thanks for joining us for our second quarter macro presentation called The Tide Goes Out at Narwhal Capital. My name is Ben Nye. We'll be talking about what happens when the monetary tide reverses. The thing about tide changes is that they can happen slowly, almost imperceptibly. But over a period of hours, you can most certainly figure out whether the tide is going in or whether the tide is going out. For a number of years, the monetary tide rose in the US and most developed markets. There were times when the tide stalled or partially reversed, but in general, the tide was rising. This took the form of low interest rates, negative real interest rates, and strong returns to what they call carry trades and lowish volatility. Growth was fomented by expansion of the monetary base and credit eased over time. However, beginning last year, the Bank of England, Federal Reserve, and the European Central Bank led the charge to tighten monetary policy at a relatively aggressive cadence. In the short term, it can be difficult to spot the tide changes, but today it is becoming clearer and clearer. So this is what we'll explore in this macro presentation today, and we'll also examine the consequences thereof. Here's a disclosure, which essentially says that these are our beliefs, but do not take them to the bank. We're not selling nor attempting to convince the reader of any one particular course of action, and past performance does not guarantee future results. Jesse Livermore was a famed investor in the early 20th century. He was profiled in Edwin Lefebvre's famous Reminiscences of a Stock Operator, a book I would highly recommend for anyone who's interested. It's an entertaining read. He was a trader and frequent visitor to what they call the bucket shops, where you essentially bet on margin on various stocks. He also lost everything on multiple occasions, not too dissimilar to the story of John Maynard Keynes. He talks about ebbing tides and that fact that trends come like a series of ocean waves. And for him, who was trading mostly on feel and technicals, he would put a lot of stock into whether tides are coming in or whether tides are going out. Overall, the investment landscape has not really changed. We introduced this framework last July at in our macro presentation at that time, and we believe it continues to be a framework that governs the current macroeconomic world. So far, the impacts have been a little bit milder than we anticipated in July, primarily due to the combination of wage increases and falling oil prices. Core inflation has begun to decline, and while the Fed's job is not done, the upside risks to this framework have increased and the downside risks have fallen. The issue now becomes that as the Fed has become more aggressive, we've moved to the lower portion of this framework. We've moved through lower real consumption. We've moved to lower business profitability. And as a result, you're seeing cost cutting and job losses, as we've seen from various announcements over the last 6 and 3 months, especially. And we've also seen a little bit less access to capital. We've begun to see some bank failures, and we're going to talk about that extensively over the course of this presentation. Now, the question now becomes, is inflation lower enough to manifest itself in Fed rate cuts, which would be the end game, or does this cycle continue, and has the Fed not received what it wanted yet? And will the Fed continue to obstinately push for more interest rate hikes? That is the question before us, and that's probably the biggest downside risk, that the Fed continues to hike interest rates. On the investment strategy portion, summing up, it's very important to maintain good capital allocation. That's on your personal side. Make sure that when you're spending money wisely. And within equities, that you're spending money on companies that are good allocators of capital. And then within fixed income, you're maximizing your return. If you have cash in a rainy day fund, and we'll talk a little bit more about this, look for opportunities to deploy that in potentially very low risk money market funds or short-term T-bills, because that money is just sitting there and you can now earn a real interest rate on it, versus in the past, you've been losing to inflation. Now that's flipped a little bit. So we'll talk a little bit about what it means when the tide goes out and what that looks like from a macroeconomic data perspective in terms of inflation, what quantitative tightening means in terms of employment. We'll talk about the implications, but also the opportunities of an ebbing tide, because when the tide goes out and there's less liquidity around, it creates opportunities. Illiquidity does create opportunities for people who have cash, because then they can deploy it and essentially be the buyer of last resort and take advantage of distressed opportunities. So we'll talk a little bit about that, as well as our predictions and what we're doing in portfolios as a result. Beginning with inflation, core inflation does continue to fall. It peaked last July. The orange line here is the headline inflation, and you can see that that's continued to fall. And the green line is the core inflation. Now, the core inflation has been a lot stickier, but this should begin to come down as a result of lower real estate prices. Real estate operates on a lag in these models, and so we already know that real estate will become lower as a portion of this inflation dynamic. So we would expect that the green line would fall a bit, maybe not to the speed of what the orange line is falling, but we would expect some moderation in the green line. Now, sticky services, X food, X energy, X housing does continue to remain relatively robust, even while goods inflation has fallen. So we do need to be mindful of that. However, we have received in recent weeks good news on this front. The green line here is the ISM, the Institute for Supply Management, survey of prices. And as you can see, we've significantly declined on a year-to-date basis, back down to 59.5. In fact, we're at levels that we were at really in 2012, 2013, 2017, 2018. So on the services side, we would expect that this would manifest in a way that's much more consistent with a 2% or maybe even a little bit less than that in terms of an inflation print. Manufacturing prices are already in deflation. Anything below 50 in this chart indicates that prices are falling on average. Anything above 50 suggests that prices are increasing. But as you can see, even on the green line, prices are falling at prices are rising at a bit of a slower rate. And part of this is that new orders are slowing. This has been a big trend in manufacturing for quite some time. After the COVID pandemic, there was a big rush to buy and buy ahead because people were having such difficult time getting inventory. But that has since reversed, and now new orders are firmly in negative territory on the manufacturing side. And they're volatile, but in a little bit, they're not really going much either up or down in terms of on the services side. In fact, you could argue that really since the end of 2021, we've seen a modest downward trend on the ISM Services New Orders Survey. We did move higher in January. This was in part because of cost of living adjustments and to Social Security and things like that. But the trend does seem to be toward a normalization in terms of ISM Services New Orders, which suggests a weakening of the economy. And this has happened significantly since Valentine's Day, and especially since the SVB collapse in mid-March. Employment is showing its cracks. Manufacturing employment is now negative. Again, it's below that 50 line. And services employment is pretty flat at 51.3. Not really up nor down. There are some areas of services, and we'll talk a little bit about that further, where there is growth, especially on the education, the government and education side, and state and local education. But on many respects, especially financial services, anything related to the housing market, that employment is weakening of late. These charts are taken from LinkedIn, so this gives us a little bit more of a real-time measure on what type of hiring is taking place in the U.S. economy, and it's indexed to 2016 levels. So the black line was last year. So last year in Atlanta, for instance, we're about 1.3 to 1.4 times the hiring rate of 2016. So a very elevated rate. Today, we're roughly flat to 2016 levels in terms of hiring. On the national level, on the right-hand side, you can see the significant downward trend over the past year. We are now in hiring at a slower rate than we were even in 2016. So this is a marked change since this time last year. Similarly, at small businesses, and this was not updated for the March NFIB survey, but the trend is still in place on the left-hand side, and that is small businesses are still planning to hire, but at a much slower rate than they were this time last year, and you can see that in the downward trend really since 2021. And then on job postings on Indeed are still higher than they were pre-pandemic. We indexed this to 100 pre-pandemic in February 2020, and we're still at around 130. But as you can see, they've fallen off fairly sharply since the end of last year and are now only 30% higher than they were pre-pandemic versus 50% higher just a few months ago. And as a result, you're seeing job openings per unemployed person begin to fall. Right now, there's 1.7 job openings for every unemployed person, so jobs are still readily available, but that's changing a little bit. What I would note here is that job openings per unemployed person tends not to be above 1. Typically, more people are chasing fewer jobs than the other way around. For example, when I was finishing school up in 2010, 2011, there were 4 or 5 applicants for every single job opening. Today, there's 1.7 job openings for every applicant. So the balance of power has shifted significantly in favor of the workers, but that appears to be potentially normalizing as job openings are pulled. The February JOLTS job openings report showed just 9.9 million job openings, down from 10.5 million in the prior month. And with the labor force participation gradually inching up, I do think the state of play may be shifting for the economy overall. So it'll be very interesting to see what happens with this going forward. Regardless, it should have a softening impact on wage growth. And you can begin to see that on this chart. This is wage growth among job switchers and job stayers. The orange line is job switchers, the green line is job stayers. And in a strengthening economy, the orange line tends to move above the green line fairly quickly. And the reason for this, it makes a lot of intuitive sense. The people who are switching jobs are moving jobs to something that pays more money. But when the economy is weakening, people are not switching jobs because it pays more money. People are switching jobs because they just got laid off and they just need a job. And so in 2008, 2009, you actually saw this. And the people who were switching jobs had experienced less wage growth than people who stayed where they were. And I'm not saying we're not there yet, but we are certainly moving that direction. And as the amount of pay for job switchers begins to decline, we should see some tempering in wage growth overall. And we'd expect to see this progress as the year progresses as well. Having said that, even though wage growth is beginning to slow, real average hourly earnings has recently stabilized a little bit. The last reading was down 0.7% for the month of March. And this is a significant improvement from the -3% and change from last summer. And the reason for this is that inflation has begun to fall. And so on a real basis, when you take, even though you might only be getting a 5% wage increase, you're only dealing with inflation that's 5.7. Versus last year, you might have been getting a 6% wage increase, but inflation was 9% or higher. So this is good news, and it allows Americans to begin to save a little bit more money and bolster and reduce some of those credit card bills. And you can see that in this chart on the left-hand side. This is a Bank of America chart that estimates the monthly excess saving and the total excess saving accumulated since the pandemic. During the pandemic, large amounts of savings were accumulated, in part because of PPP loans, the checks that were sent out, but also the lack of spending that took place. And so you saw a big increase in excess savings. That's begun to be been drawn down. It started to be drawn down in the middle of 2021. And at 3 months ago, we were going through $100 billion a month, and we only had about $1 trillion left of these excess savings. So we were concerned that the money essentially could, for lack of a better term, run out by October of this year. Now, although we only have $930 billion of excess savings today, our burn rate has fallen to 70 billion. So do you do the math? 70 over 930, and you're 930 over 70, and you're talking a bit about a much longer lead time. So versus in 3 months ago, we were talking about October as the savings run out. Now we're talking probably about the middle of next year at this rate. And we'd like to see this continue to become more and more asymptotic so that we just continue to push that out until it almost becomes indefinite. And we actually hold on to some of those excess savings accumulated. Encouragingly, savings as a percentage of disposable income have increased as inflation has fallen. This is what we'd like to see. And we'd like to see continued progress on this metric as well. Nevertheless, consumers have pulled back after a strong start to the year. December was weak, in part because of early buying for the holidays, as well as pretty unfavorable weather. January, though, picked up in a big way. Very favorable weather. Again, you had the cost of living adjustment for Social Security, which increased essentially the income for Social Security recipients by upwards of 9%. So that had a nice boost to spending in January. But since that time, normal service has resumed, and that has been toward a declining trend. And the trend has really been driven by ticket, which means that there are a few ingredients in there. Number one, yes, inflation is coming down. So that's one ingredient. Number two, people are buying fewer items when they make a purchase. So they might be still having the same number of transactions, but they might be purchasing fewer items per transaction. And then number three, they might be shifting down to a cheaper product. Costco's talked about this, Walmart's talked about this. People are actually still buying a similar amount of television units, but they're buying them in that they're smaller screen sizes. So they're buying cheaper TVs. They're still buying TVs, but they're buying cheaper TVs. So that's one of the reasons we're seeing the ticket begin to decline as well. Transactions have begun to decelerate as well, and we might expect to see a little bit more transaction deceleration here in the coming months. We have been getting some more consumer data from the back half of March since the SVB collapse, and we've seen some further deterioration in these metrics since then. So consumers are pulling back, and we'll continue to watch it carefully. They're actually in a little bit better financial position on a cash flow basis than they were this time last year, but they seem to be normalizing and seem to have a sense that maybe they shouldn't buy that extra large screen size TV, or maybe they should buy the generic brand versus they should buy the private label versus the national brand. Credit quality is normalizing. And again, this would make sense given the savings rate has improved. So on the consumer side, we actually feel relatively good. The card delinquency rate, the green line, has stabilized after moving up a little bit, and the savings rates has improved, which means that you now are closer to paying off your credit card with savings than you were a year ago. Home builders have seen some stabilization. In fact, KB Home was talking about February being the first sequential increase in activity in 13 months. And buyers seem to be acknowledging that these higher rates are the new normal. So March was relatively good for KB Home even after the SVB collapse, because in part mortgage rates normalized. So home buyer demand is still down versus where it was the last 2 years, but people still want to buy houses, and they're trying their best to find those houses that they can afford, even if it means accepting a little bit of a smaller home as a result. We did note mortgage rates have paused out a little bit in around the 6.5% range. And really, we think that mortgage rates should be actually a little bit lower than they are even now. They probably should be around about 530 to 550 based on their historical correlation with the 10-year interest rates and financial conditions. We did a lot of work on this and built a model that would suggest that we should be between 530 and 550. Right now, we're at pretty historical highs in terms of the residual. So this basically means that we think there should be some normalization here, and we have to explain why is there a 100 basis point difference in the current mortgage rate and the rate that we would model. And the reason is you're seeing a lot of mortgage owners exit the market. The Federal Reserve is exiting the market. Banks are exiting the market. Wells Fargo's getting out of the servicing business. JP Morgan said it just doesn't make any sense to own mortgages as a bank right now. And then you also have a lot of banks themselves who deployed capital in treasuries and mortgage-backed securities in 2020 and 2021, like Silicon Valley Bank, who are now liquidating those mortgages. So you're seeing a lack of a natural buyer and a forced seller. And when we talk about the tide going out, creating opportunities, this is one of those opportunities that we talk about. Because you have people here who are distressed sellers or forced sellers or exiting the market for other reasons, you can actually go ahead and take advantage of that if you have the cash and if you have the liquidity to deploy that. In terms of economic expectations going forward, the left-hand column shows the current trend. So GDP, that's your fourth quarter GDP, will probably be in the 1 to 1.5% range, it appears, for the first quarter, but second quarter might be a little bit soft. In fact, I believe consensus is negative at this point in time. So 0.9% is about the current trend of GDP. Unemployment rate is 3.5%. And core inflation is 4.6%. The Federal Reserve thinks that by the end of the year, inflation will be down into the 3.5% range, and unemployment will be up to the 4.5% range. The Federal Reserve, importantly, in its minutes released on April 12th, said that they expect a mild recession later this year. That's a big piece of news. Because that's been implied by their guidance of that 0.4%. Because if you're running at 1% in Q1, at some point you're probably going to go negative. And the Federal Reserve actually admitted that in the minutes from its March meeting. So we're very cognizant of that. And we're also cognizant of the fact that the Federal Reserve continues to think that they will actually increase interest rates one more time in 2023, maybe in May, maybe in June. The point here is that the Federal Reserve expects unemployment to go up by another percentage point by the end of the year. So this would imply some more significant economic weakness. And so that's something that we're watching closely. They do expect that they will be cutting rates in 2024 and 2025 and allow GDP to drift upward a little bit more. The Federal Reserve has been famously wrong in many of its projections over the past couple years and even long beyond that. They were very wrong in their predictions of even what they could control last year. They thought they would raise by 75 basis points. They ended up raising by over 400 basis points. So you take these projections with a grain of salt. Nevertheless, it's probably a good estimate of where we are today, and it's something to bear in mind, especially as the tide goes out. Real rates have stabilized at relatively high levels. These are one of the biggest drivers of equity market valuations. When real rates are low, equity market valuations tend to be higher, and vice versa. Over the past year, the Fed has been desperate to correct its overly loose monetary policy. So they pushed through a series of very aggressive and unanticipated rate hikes, driving real rates dramatically upward and equity market valuations down. Thankfully, the recent normalization in real rates has helped to support equity market valuations. The S&P 500 was up about 7.5% in Q1. And this has happened despite relatively downbeat economic news lately. So if we do enter a negative growth period, we have at least built in some tools that will allow us to support the economy during the recession, namely cutting interest rates. And this, when we talk about the tide, this is what we're talking about. If there's one chart that you take away from this presentation, it's this slide 26. M2 money supply has experienced a decline for the first time in recorded history. Now, that data only goes back since 1960, but this is hugely significant. M2 is a measure of the amount of money in the economy. It includes cash, deposits, other types of deposits that are readily convertible to cash, such as CDs. Never before has the M2 money supply contracted over the prior year, and the money supply is currently contracting at an accelerating rate. While we acknowledge the fact that the money supply is still higher than pre-pandemic levels, it's the rate of change that people tend to care about. And this has important implications, because as M2 falls, so does deposits. And it's not really a surprise. Deposits are an ingredient in M2 money supply. On top of this, you also have a movement out of low yield checking accounts into higher yielding treasury securities. And so when you hear these news about deposits flying out of US banks, part of that is because of the Federal Reserve itself. And this has significant implications because deposits are the cheapest cost of funds for a bank. You can use that to fund your loans. And when you have a cheap cost of funds, you can make more loans. When you have a high cost of funds, and when deposits are going the other direction, you can make fewer loans. So if you follow the bouncing ball here, lower deposits equal lower profitability at banks. Lower profitability at banks means lower loan capacity. They can't lend as much credit. And lower loan capacity means more expensive loans for consumers and businesses, which means they have to make better decisions with their capital and make sure they allocate capital to the best places. And so here you can see the deposit change adjusted for inflation. We index this to the CPI. And again, a lot is made of, well, deposits are still higher than they were pre-pandemic, and that's true. But as you can see, they're falling at 10% in real terms, and they're only about 10% higher than they were pre-pandemic, which isn't that a whole lot over the course of 3 years when you compound that. So it really limits the amount of growth that you can have in the economy. So as real deposits go negative, this creates a little bit more stress in the economy. It creates more stress in the financial system, and that all leads us to what happened to SVB. SVB is a natural consequence of what the Federal Reserve has done. And this is the transmission mechanism for the Federal Reserve. It creates more tightness in credit. That's what it's designed to do. Was it designed to take down SVB specifically? No. But one of the impacts is that it creates tougher funding conditions. And management teams who haven't been fully attuned to the situation will struggle to deal with that reality. This quote from Jesse Livermore, again, continuing this theme: the nature of the game as it is played is such that the public should realize that the truth cannot be told by the few who know. And the difficult thing about being a bank analyst is that banking and currency in general is a system that relies on trust. As a client, You are relying, or a depositor in a bank, you are relying on the promise that your money will be there when you want it. The problem with a system that relies on trust is that once that trust is put into question, the entire spool of thread can unravel. This is why we rely on regulators to ensure that banks can meet demands and that trust is maintained. Once this trust is breached, it is very difficult to put the genie back in the bottle. So this is what happened with Silicon Valley Bank. Essentially what happened was they had an influx of deposits in 2020 and 2021, but they didn't have anywhere to put those funds. So you get a bunch of funding that you have to pay some interest on, 25 basis points, say, and you have to earn that interest by investing it. Well, what are you going to do? Interest rates are zero, and no one needs a loan because they're getting free money from the government. So Silicon Valley Bank said, well, we need some yield on this. So they went and bought longer yielding treasuries and mortgage-backed securities, very high credit quality, sterling credit quality, because the mortgage-backed securities are government agency backed. But they had a component that's called duration, which means that as interest rates rise, the fair market value of those securities fall. They'll still mature at par, but you have what they call a duration mismatch. So as interest rates rose, the value of their investment portfolio, these treasuries and mortgage-backed securities, fell. Capital became tight, and depositors simultaneously took out their money, like they've been doing at all banks. You saw that chart on M2 money supply. So when the depositors wanted their money, these banks as Silicon Valley Bank, had to lock in the loss on those treasuries and mortgage-backed securities. And it essentially created a hole in the balance sheet. So where deposits are a liability for a bank because it's something that the bank has to deliver on, a loan or an investment is an asset for the bank. The value in the assets fell. The depositors still wanted their money. And so as your liabilities are held constant and your assets fall, that creates an equity hole. And as a result, you have to raise capital to plug that equity hole. So that's what SVB did by hiring Goldman Sachs. They wanted to do it quietly. They wanted to do it very quickly. Moody's was threatening to downgrade them. And so they wanted just to get this done. And so they really pushed to do a hybrid deal, relying on two anchor investors, Warburg Pincus and General Atlantic. But the problem is they were pushing so fast to get this deal done because Moody's was threatening the downgrade that on March 5th, Warburg got cold feet. They were saying, we don't know why you're going so fast. We don't really want to do this. And so when Warburg dropped out, Goldman ended up having to go out to public investors and ask them for money. And so they lined up an offering. They lined up the book. And the stock fell, but stocks always fall when you announce a public offering. The problem is Silvergate then shut down. That was the crypto lending bank. And then Moody's downgraded SVB at 8 p.m. Still, they thought they could get the deal done. SVB shares went down further, but Goldman thought they could get the deal done. When at the close of business, however, they got the report on the number of depositors who took out the money, the lawyers said, you cannot continue with this offering without disclosing the number of deposits that have fled the company. And at that point, there was about $40 billion in the space of 24 hours that just rushed out of the bank. This is a $200 billion deposit institution. So you have a fifth of your deposits go out the door. And Goldman said, if we disclose this, no one's going to buy this deal. So we're not going to disclose it. We're just going to can the deal. And that's what they did. And the FDIC took it into receivership the next day. Here are the tweets. I think this is an interesting aspect of this whole situation. And that is that the fear that was stoked by the tweets. And there are laws against this. There are reasons you cannot incite a bank run. And you had a bunch of venture capital people and very influential people talk about the fact that Jason Kalakanis, said, "You should be absolutely terrified right now." That 5 million people saw that tweet. Gary Tan, who is the CEO of Y Combinator, said this is an extinction level event. Bill Ackman, the famed hedge fund investor, had 7.4 million views on this tweet in the bottom left that says depositors will get 50% of their money on Monday and Tuesday, and whatever is left over the next 3 to 6 months. Again, the Jason Kalakanis said Americans will be lined out the door demanding their money. The bottom line here is the tweets definitely incited a firestorm that helped to drive the deposits down and contributed to the collapse of SVB. So as we look at the blame game, the blame shifts. But the fact of the matter is all are at fault. Regulators, they were aware of the issues of SVB. They brought it up to the Federal Reserve, but no action ended up being taken. Management probably shouldn't have been so aggressive in terms of going out and taking significant duration risk with those mortgage-backed securities and treasuries. The people who are tweeting, again, cannot do that. Depositors, I hate to say it, but they're the proximate cause for the bank collapse. If they didn't pull their money, this probably wouldn't have happened. And then, of course, the Fed rate hikes. When you say that you're going to raise rates 3 times, and then you raise rates 17 times, is it the Fed's problem that they didn't forecast properly? Or is it management's problem for trusting the Fed would do what they said they were going to do? I think it's probably a combination of both. Of course, no one party wants to take responsibility for the collapse. And the fact of the matter is, all contributed to the collapse, and it probably wouldn't have happened without mismanagement at each one of these avenues. But rather than looking in the rearview mirror, what are the implications? The implications essentially are tighter capital. SVB wasn't the only bank that failed. It also Signature Bank, Silvergate, Credit Suisse. Bank regulations will almost certainly increase. The Biden administration has already proposed new legislation targeting the called mid-sized banks. Politically, this is attractive because it contrasts the regulation-focused Biden administration with more laissez-faire policies of the Trump administration. At the same time, more regulation would almost certainly not have prevented the SVB collapse. It's an attractive political point, nevertheless. Banks are likely to be forced to pay higher rates on deposits in order to prevent withdrawals from clients. American people and companies will be focused on keeping balances below $250,000, below that FDIC threshold. So they're going to require additional interest to do so. So that'll result in a higher cost of funds for banks. And we talked about, you have higher cost of funds, you have less profitability, you have less capital that you can lend out. And when you have less capital that you can lend out, you're going to tighten your credit standards. If you only have a certain amount of money that you can lend, you're going to make sure that you get the best bang for your buck. You're going to lend to the people who are asset-backed, who have banked with you for a long time, who have very good sterling credit quality. You're not going to take a chance. And this is the implication of tighter monetary policy. You ultimately have superior capital allocation to when you have very loose monetary policy. And that's probably not a bad thing. But when it happens all at once, it can create shockwaves throughout the industry. Today, loan quality is holding up okay. The non-performing loan index is somewhat elevated, but not egregiously elevated historically. At the same time, loan volumes on the right-hand side are tanking. And they're tanking because credit standards are increasing so much. Credit standards here means tighter credit is a negative value. And so credit standards are being raised across the board on consumer, on commercial and industrial, commercial real estate, even residential real estate. Credit standards are being raised. And this is a survey from the Dallas Fed that was a little bit more insulated from some of the more national data. And I expect that when we get the national data, on credit standards and loan volumes for the month of March. Post SVB collapse, we're going to see these trends writ larger on a national basis, even in Dallas. So the implication means that capital allocation becomes paramount. CFOs need to be, it's the return of the financial CFO, not the capital raiser CFO, not the one that goes out and sells his stock and tries to raise capital. It's the CFO who can be efficient, can select those projects that are higher returning. CFO that has the willingness to say no to certain projects. And you can see that the companies that have performed best are those ones that are becoming efficient. Meta has been laying off people, focused on efficiency, and the company has been performing a lot better. And there are opportunities for high return projects. Businesses with low returning projects may not be possible with higher costs of capital. If all your business model is to take in free money at 2% or 1% and invest in real estate at 4%, that's going to be a very difficult business to continue with. You need returns on capital that are well north of 10% in order to really justify what you're doing these days. So allocating that capital effectively becomes extremely important. And what we're going to see is we're going to see this shift. We're going to see a shift from the bigger become bigger because they have all this access to the free money. So when money is free, you borrow, you buy back stock. It's a lot easier for the big to become bigger because it's less about the skill and just more about the quantity. When capital becomes tighter, it becomes a lot more about capital allocation than capital quantity. And so we've actually seen over the last few years, the weights of the 10 largest stocks in the S&P 500 reach historic highs. That's beginning to change, and it began to change with this quantitative tightening and tightening in monetary policy. That's actually good for active investment managers. The left-hand side, Amundi, the asset management firm, did this study. And the blue diamonds demonstrate the percent of active managers who outperform the S&P 500. And you can see that when the S&P 5 concentration in terms of the top 10 stocks is falling, you actually have a fairly large number of active managers outperform the S&P 500. And so I think that we could be set up for a similar scenario this time. So this could mean a return of active management because, again, the returns will accrue to those with the skill to allocate capital, not just to capital. And I think that's a big distinction and potentially a paradigm shift of where we're going. Again, capital allocation over capital quantity. So what are some opportunities? Well, we'll talk about a few of them in terms of portfolio construction. Jamie Dimon, his thoughts are that there's probably going to be some less predictable geopolitics. We're going to transition from a savings glut to scarce capital, which could mean higher inflation, higher interest rates. He also says that the crisis isn't over, but we would also agree with him that consumers are in better shape than they were in 2008. On a broad asset allocation basis, I think it's important to maintain your broad strategy. You don't want to be shifting because the market shifts. Your asset allocation is unique to you, and it's dependent on your ability to take risk, your willingness to take risk, and the requirements for your portfolio, whether that's income or return. But look at those needs, evaluate those needs, because now you can actually get a decent return in fixed income. And it can actually serve as a more effective driver of return at lower risk than on the equity side. So you can look at that, and you can also optimize your individual asset classes. If you have a rainy day fund, if you have cash on the sidelines, it can be useful both from a discipline perspective and a return perspective, to deploy that capital, even if it's just in a money market fund. You can actually make a real return. So if you have $10,000 that you just want to, this is my rainy day fund, this is just going to sit on the side, invest that in a money market fund and make $400 over the course of a year. It might not sound like a ton of money, but it's $400 in free money that is just sitting there. So be very intentional about how you're allocating your capital. And if you can afford to defer spending, if you're thinking about buying a new car, consider buying it next year, because in the meantime, you can actually make money on that cash that you have saved. On the individual asset class level, fixed income, you're getting lower term premiums for now. This probably won't persist for a long time. Right now, the curve is inverted, which means that you get more money, more interest on short-term fixed income than on long-term fixed income. But again, we think that this will change somewhat, especially if the Fed does cut interest rates, which we would expect over the next year or so. So in that scenario, you would likely see all interest rates fall, but with the 2-year falling faster than the 10-year or the 30-year. So it does make sense to layer in different vintages of fixed income and make sure you're locking in these higher returns for a longer period of time. Municipal bonds have become more expensive, whereas this time last year we were talking about municipal bonds that on the 10-year basis that was trading roughly equivalent to treasuries, and that's before your tax equivalent boost. So on a tax equivalent basis, you were getting about 130, 140, maybe even 150% of treasuries. Today, on a tax equivalent basis, you are about breaking even with treasuries on a tax equivalent basis. This is on the 10-year. If you go out further in municipal bonds, if you go out to 20 years or 30 years, you can make more money on municipal bonds on a tax equivalent basis. But right now, things are trading fairly tight as investors pile into municipal bonds. Mortgages are one area where we do see opportunity. Again, we think that mortgage-backed securities offer attractive returns relative to the 10-year. If you look back at how it's traded in the past, we're at historically wide rates. We're 100 basis points premium to 10-year notes. Back in 2021, this was about even. So you are getting a little bit more spread on mortgage-backed securities than you did in the past. In terms of equities, we would continue to emphasize cash flow, management teams that are aware of what's going on in the economy, and they're just not blindly allocating all of their capital to lower yielding returns or liquid investments. You don't want an SVB allocating your capital. And you also want companies that operate in need to have spaces, companies that service an essential product or essential business and have a relatively predictable revenue stream. Much is going to depend on the Federal Reserve. The difficult issue with what we have now is that a lot of the issues that we're facing and what caused the SVB collapse and Signature and the like is dependent on the Federal Reserve. And because of that, as difficult as things are, they could be solved if the Federal Reserve adopts an easier monetary policy. We don't expect that, but we are cognizant that that switch could be flipped at some point. It's unlikely to be flipped when inflation is still elevated, but it's something that we have to stay aware of. So examples of businesses that we currently own and have been purchasing, we'll just talk about 4 very quickly here. Costco. We believe Costco has a sticky and loyal customer base with a strong leadership position in price. So they should preserve gross margin over time. They have a very strong balance sheet with no need to raise debt or even renew leases because they own most of their properties outright. They may actually pay a special dividend within the next 12 months, they've alluded to. And when viewed through an asset-focused lens, when you look at gross value of their real estate, we believe the shares are quite cheap. Raytheon's a company that we've owned for quite some time. They have a strong and stable business with an increasingly fortified position in missiles. The U.S. has actually shown a recent desire to favor them over Lockheed Martin. But we also like the company's exposure in the commercial aircraft industry. They own Pratt & Whitney, which competes with General Electric and Rolls-Royce and jet engines. And that has a lot of operating leverage and underlying earnings power that's going underappreciated by the market. They also generate really nice free cash flow. ChampionX is a relatively new company on the world stage. They are the product of a merger that happened in 2019 and 2020, but the business units have been around for over a century. The business does not require much capital, and now they've paid down the debt related to the merger. The company is poised to continue large buybacks due to its large and growing free cash flow. CHX also participates in an oligopoly. They have about 30% market share in their core business, and their price increases have been fairly well received by the industry over the past year. So we think that they're going to be able to generate over $3 in free cash flow 2025, and that this poses a really nice port in a storm, even within the energy space. T-Mobile has made strong moves in its client base and has a leading spectrum position, whereas AT&T and Verizon had forays and really strayed from the path in the mid-2010s. And in 2010s, T-Mobile was focused on building the next generation wireless network. So think of where Verizon was in the early 2010s, and that's where T-Mobile is today, which means Verizon and AT&T are going to have to play catch up, whereas T-Mobile is going to be able to print some additional cash. And we think that they're going to generate very substantial free cash flow and return a lot of that to shareholders in the form of share buybacks and dividends. So to sum up, when the tide goes out, as we noted, that Jesse Livermore quote, surprises are going to be likely. People don't want to tell bad news, and so they don't tell bad news until it's too late, and then it hits all at once. So that's going to be a characteristic of what we see in this ebbing tide environment. So think SVB. We expect to see more of that. Warren Buffett was interviewed in Japan on Wednesday, April 12th, and he says that he continues to expect that as well. The Federal Reserve may need to cut interest rates. We would posit that they should be cutting interest rates today. We do think that credit's going to come more hard to come by. So think about auto loans, home equity lines of credit with businesses, private equity, raising capital. That's going to be a lot tougher. It's going to be a tougher environment, and the capital, again, is going to accrue to those who can adequately allocate capital and have skill allocating capital versus people who just thrive on raising money. But we do think that the consumer may hold in better than expected. We're seeing some positive trends on the savings rates and real average hourly earnings. So even as the employment market loosens a little bit and it's more difficult to find jobs, we think that real average hourly earnings should continue to stabilize, and that should allow us to get through this with potentially a recession, but one that the consumers should be able to persist through. In terms of Narwhal, we do have a weekly market memo that is issued on Friday. So if you would like to be added to that list, let us know. We've been speaking at various conferences. Jason Sieb, one of our analysts, he spoke at the Hedge Week webinar doing that. I spoke at the Harvard Club in New York City, which was an interesting experience for me. That was the first time I've done something like that. And we're always here. We're here every day. We're here to talk to you. We're here to answer questions, even if they're not easy questions. That's what we're here for. So call or email us, set up a meeting. Happy to meet whenever and wherever you'd like. And on that note, I would also say that we have recently hired a almost a hybrid role. This gentleman will be working from between the client service department and the portfolio management department. He's interned with us for the last 8 months. He's a great guy, graduated from UGA. His name is Moa Reza. So say a congratulatory note to him. We're really excited to have him. And on that note, we'll end it there. The tide goes out. Have a great day. Let us know if you have questions. We'd love to hear from you. Thank you.